consolidated statement of profit or loss and other comprehensive income for the year ended 31 December 2011 of the P Limited Group. The principle behind every line item in the consolidated SPLOCkie is taking 100% of the parent, add to that 100% of the subsidiary from their respective trial balances, and then adjusting these combined totals for the effect of consolidation journal entries if and where necessary. This gives effect to the single reporting entity concept. The first line item is revenue. My starting point is 100% of P plus 100% of S from the respective trial balances given earlier. Included in the revenue of the parent is revenue from selling inventories to the subsidiary, which was intragroup. We wrote a consolidation journal entry, Journal 2, to eliminate this intragroup revenue. The journal entry was a debit to the revenue of the parent. The effect of that journal entry is to reduce the combined revenue totals. After this journal entry was taken into account, the remaining revenue of the group represents revenue from third parties only. The next line item is cost of sales. My starting point is 100% of the parent plus 100% of the subsidiary from their respective trial balances. At this point, it's important to remember that cost of sales comprises a calculation of taking opening inventories plus purchases less closing inventories. During the current year, there was intragroup purchases. We wrote a consolidation journal entry to eliminate the effect of the total intragroup purchases. In Journal 2, we had a credit to cost of sales of 70,000 Rand, and this is the effect of that journal entry. It gets rid of the total intragroup purchases. In this example, there was unrealized profit in opening inventories. What we want to achieve with your unrealized profit in opening inventories is that unrealized profit gets realized back into the gross profit of the group during the current reporting period when those inventories have been sold to parties outside of the group. We wrote a consolidation journal entry, Journal 4, where we had a credit to the cost of sales of the selling entity being the parent. The reason for the credit to cost of sales was to reduce cost of sales of the group and then ultimately increasing the gross profit of the group, as this profit is now realized for group statement purposes. If you look at the effect that this 400 has on the line item cost of sales, you would see that it achieves exactly that. If we make cost of sales less, we increase gross profit. The next journal entry that affected cost of sales was for the unrealized profit in closing inventories. At the end of 20X11, there was still intragroup inventories on hand. That indicated that there's still a profit included in the gross profit of the selling entity that's not allowed to be part of the group's gross profit. We wrote Journal 5, where we said debit cost of sales of P. This is now the effect of that debit to cost of sales. We are adding that 600 to the cost of sales line item. The effect of adding to cost of sales is a reduction in the gross profit of the group. So in this example, you can now clearly see on the cost of sales line item the effect of the consolidation journal entries. Please make very sure in a question and homework questions and any examples that you practice that you pay a specific attention to your signs. If you apply the incorrect sign in your calculation, you're making a principal error and you will have to be penalized. The rest of the line items in the consolidated SPLOCkie only comprises adding 100% of the parent to 100% of the subsidiary. There was no other intra-group transactions to eliminate, therefore no further journal entries to consider. When you present the consolidated statement of profit and loss, please always remember to do this bottom section, as a lot of marks is usually absorbed into these amounts. What you now have to do is to take the total profit of the group and indicate how much of that is attributable to the equity participants of the subsidiary, being the owners of the parent and non-controlling interest. If you remember correctly, in Journal 7, we have already calculated the profit attributable to NCI as 19,500, and then you just balance back to what is attributable to the owners of the parent. There isn't any other comprehensive income in this example, so the total comprehensive income attributable to the owners of the parent and NCI is exactly the same amounts. We will now look at the analysis of equity, as it is a very helpful calculation when you have to present the consolidated statement of changes in equity. The purpose behind the analysis of equity is to analyze the total equity of the subsidiary. We have three very distinct periods. We have the at acquisition date, we have the since to opening balance period, and then we have the current reporting period. The at acquisition section helps with the writing of the at acquisition consolidation journal entry, and then the rest of the analysis is in the same format as your statement of changes in equity, being opening balances and current year movements. The at acquisition section, the amounts we already discussed when we did the at acquisition consolidation journal entry. It was the share capital and retained earnings, which was the only equity items of the subsidiary, compared to the cost of the investment and the measurement of NCI, and I had a resultant goodwill of 5,000 Rand. When we now analyze the since to opening balance equity of the subsidiary, we follow the following thought process. You always start with the trial balance equity item. It's only retained earnings in this example. The TB balance, opening balance, is 42,500 Rand. Then we ask the question, was there any consolidation journal entries that adjusted that retained earnings opening balance of S? And if your answer is yes, you consider the effect of those journal entries and adjust that TB balance before you attribute. So you first get the total that is allowed to be in the group, and then you attribute. It's two very distinctly different steps. The only consolidation journal entry that changed the retained earnings opening balance of S was the at acquisition journal of the 7,500 Rand. The other debit to retained earnings opening balance was that of the parent for the unrealized profit in opening inventories. It was the parent that was the selling entity, therefore that 400 Rand is not taken into account on the analysis. That then gives you the total retained earnings that is allowed to be in the group, that then gets attributed to the parent and NCI. Please remember these amounts, as we will use them when we do the statement of changes in equity. Same approach for the current reporting period. You start with the TB profit or TB movements in equity of S, the first one being profit for the year. Then you ask the question, was there any consolidation journal entries that changed profit or loss items of the subsidiary that also caused the profit of the group to change? In this example, we did have consolidation journal entries changing cost of sales, changing the profit of the group. But each time we had a cost of sales consolidation journal entry, we were changing the cost of sales of the parent being the selling entity. So the profit of the subsidiary does not have to change in this example before we attribute to the parent and NCI. So the 65,000 is allowed to be in the group. That then gets attributed to the parent and NCI. Please remember these amounts for when we do the statement of changes in equity.